friend, Namaskar. Welcome to today's session. Today we are going to discuss the adjusting entry. Till now we have discussed the process of accounting, principles of accounting, different objectives and the users of accounting. So today for preparing final account, that is trading and profit and loss account and balancing, there are some errors, there are some mistakes, there are some adjustment entries are required. So today we will discuss what are the different types of, and next one is what are accounting principles. This is very important. Earlier we have already discussed, so today we are going to define. So these are nothing but it is the common rule and must be followed for preparing financial statement, because these are the guidelines and these are the rules, methods and procedures, and that will be distributed to the people outside the company and the organization so that they can know the principles of it. My dear friend, so the next one is very important for the adjusting entry, that is time period assumptions. So time period assumptions discuss the economic life of the business. The whole life of business is divided in a month or in a quarter or in a year. Usually we are taking one complete year, either this is January to December or April to March. So this is the period for which we are recording and we are preparing. Beyond that and before that, if there is any transactions, we are not considering for making the financial statement. So this accounting period concept or the time period concept is very important for adjustment, and this is the basis for the adjustment entry. So here period may be less than 1 year, that is called interim period, and the period of 1 year is called the financial year or fiscal year. So next very important principle is that matching principle. This is also the backbone of our adjusting entry, because we have to match the expenses with the revenue and revenue with the expenditure. If we have spent the money and we have not got the services, we have to recognize that one. And if we have given these services and yet we have not got the money, that we have to again record that one. And if someone has did some work for us, so that is called outstanding expenditure, that we have to consider in preparation of account. So my dear friend, next we are proceeding what adjusting entry. What does it mean? Adjusting entry makes the revenue recognition and matching principle happen. So next one is, that is again very important, in the bank reconciliation. What happens to outstanding checks of the previous year? So these all are required to be done for finalization of the account. So here a small answer is given for your help, so you try yourself. Next one is again for your homework, how much you have understood. So here some of the questions I have framed for you to revise yourself. So here 5 questions are given. If you want to get checked with by me, you may mail me or you may WhatsApp me the answers. I will help you. So next one is again, I have given you the answers. If you feel any difficulty, you can refer it. So So next one is the adjusting entries. Adjusting entries are required each time financial statements are prepared. Without it, there will be no correct view of the financial position of a business. It can be classified under two heads, that is prepayments, that is prepaid expenses, or unearned revenue. And next one is the accrual, that is accrued revenue or accrued expenses. And the third one is estimate, that is amortization of goodwill and the preliminary expenses. And type of adjusting entry, just we have discussed, that is the prepayments, prepaid expenses. This is paid in advance. And unearned revenue, revenue received in cash and recorded as liability before they earn. Next one is the accrual, accrued in revenue or income but not yet received in cash. This is the expenditure which is incurred but not yet paid. Next one is the estimates, amortization. So here allocation of the expenditure. Prepayments, prepayments are either prepaid expenses or unearned revenue. For this, adjusting entries are required. Next one is again fill in the blanks. You have to try yourself. Next one is prepaid expenses. It is paid in advance, but services yet to be received. Prior to adjustment, assets are overstated and expenses are understated, so that there is a need of adjusting entries. Examples are given here: prepaid expenses, clothes, supplies, rent, insurance, and property tax. Next one is unearned revenue. These are revenue received and recorded as liability before they earn. Unearned revenue are subsequently earned by performing a services or providing goods to a customer. So a liability revenue account relationship exists with earned revenue. So here prior to adjustment, liability are overstated or revenue are understated. The adjusting entry result in a debit to liability account and credit to revenue account. Examples are here given: rent, magazine subscription, airplane tickets, and tuitions. Again, one of the very important questions for your practice is given. For rectification, there are some errors. You have to rectify that one. Here cash sales 16,000. If it is not recorded, posted as 6,000, we are posted to commission account. So what will be these things? For your help here, journal entry for rectification is given. You can practice this type of things so that adjustment entry, correction entry, these all are very fundamental things for finalization of account. So now, my dear friend, we are coming to accruals, a different type of adjusting entry. Accruals, adjusting entry for accruals are required to record revenue earned and expenses incurred in the current period. So next item is accrued revenue. This is assets revenue relationships are there. So adjusting entry is debit to an assets account and credit to the revenue account. Next one is the accrued expenses. Again here liability expenses relationship acquired. So prior to adjustment, what happens? Liability and expenses are understated. So adjusting entries result in debit to an expense account and credit to expenses payable account or liability account. So the next one is amortization. What does it mean? It is the process of allocating the cost of certain capital assets like goodwill, discount on issue of share and debentures, preliminary expenses. So, amortization is an attempt to match the cost of long-term capital asset with the revenue. So, write the correct words. Here again, one exercise is given for your practice. This is very important. Again, one test. So now the last one is the adjusted trial balance. After adjusting entries, we are posting to the ledger and we are making adjusted trial balance. So it is prepared after all the adjustment entry have been journalized and posted. It proves the equality of the total debit and credit balances in the ledger after all adjustments have been made. So this is also a check. Steps in accounting cycle. So here we are proceeding to the next part for analyzing. Second, journalize the transaction. Next one is post to ledger and prepare a trial balance. Journalize and post adjusting entries. Prepare adjusted trial balance and prepare finance statement. And next chapter, that is the final account. Thank you. Here some brief explanation and information about the trust is given, which is dedicated for the welfare of humankind. This is Vishwa Manav Kalyan Charitable Trust. For your kind help, some information is also provided.